the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hello and welcome to the Property Pod, the country's premier property investor podcast. On this Moneyweb show, we gain insider insights from leading analysts, developers, CEOs and entrepreneurs in South Africa's dynamic real estate sector. We have SA Reserve Bank interest rate decision coming up in a few weeks' time. That's the MPC's first meeting of 2025. What will it be? Another cut and the cutting cycle continuing? Or will there be a little bit more cautious in the context of global geopolitical uncertainty, as it were? And what does it mean for homeowners with bonds and those looking to buy? Joining me on the podcast now is Corné Velman of Portfolium to share some insights. Corné joined us way back about 2 years ago. And that was in a different time. Corné, welcome back to the Property Pod. It's been almost 2 years since we last spoke. A lot has changed.
Hello, Serene. Yes, it really did. The markets as well as interest rates did change a lot since I've spoken to you last time.
And that was back in May 2023. And that's when you spoke on the Property Pod. Interest rates were in a hiking cycle. In fact, on that episode, which was one of our top listened to episodes back in 2023, was titled Managing Your Home Loans as Interest Rates Spike. We're now in a downward. What are your expectations for this month's sub-MPC and for the year? Is it a little bit of crystal ball gazing, or are you more optimistic about the cuts continuing?
Serena, I still feel optimistic, but we can have to look at a few factors. On the 28th of January, the US will determine if their interest rates are going to go down, and it doesn't look like it will be. It's not been priced in their market. But if you look at our markets, there has been a rate cut that was priced in, but around about, I think, a max of 25 basis points. So I think there is a probability that they will lower interest rates, but not more than that.
And for the rest of the year, is it it's a case-by-case basis, or it's within the context of the inflation target having been adjusted? A lot of commentators are saying that we're going to have locked-in lower interest rates for longer. Yes,
I think so. If you look at our expectations for inflation, it does look positive, and we are definitely in a downward cycle. In other words, we are looking at interest rates that will be cut, but there's no clear indication that if they will cut it at every meeting or with how much, and it may stay the same. Because we've got two things that will influence it. It's our inflation, but definitely the influence from the US will, and we, with Trump doing all sorts of things now with Venezuela and that, we've got no idea where their rates are going to go. So I would say stay cautious, stay a little bit cautious. Don't expect rates to go down. But if I have to predict, I would say we're definitely going to see some cuts this year.
Okay, so there is some good news, and one of the good things is one would think that there shouldn't be any hikes barring some sort of global fallout.
No, I don't think so. We don't expect that. Anything can happen. The last time I spoke to you was just after COVID, and then, who could have predicted that? But if things go normally and there aren't suddenly some fears coming through or some extraordinary events, we won't see a hike coming easily.
And within your role at Portfolium, I know you don't give out advice, per se, but what's your thoughts on, homeowners with existing home loans? Should they be taking advantage of lower rates currently, or should they be paying more into their home loans if they have cash? Because, South Africans are clearly in a better financial position than they were a few years ago, and you have the oil price maybe spiking a little bit because of Venezuela, but the petrol price came down, in fact, in this month. So we just have to be cautious looking ahead. Do you have some tips in the reverse of our previous interview where it was a hiking cycle, but now it's a lowering cycle? What advice would you give?
Serena, I think first of all, we should just, be honest with the fact that we still have high interest rates. They are lower, but they're still high. That debt is still very, very expensive. So if you could afford your home loan through this last 2 years with the high since COVID, you should keep paying that amount. Don't lower your monthly repayment because debt is still expensive. If you see what you're paying for your home loan, if you can just pay in a little bit more. You can pay off your house with 5 years, earlier. So I would not only suggest it, but ask the listeners to not lower their monthly payment. In case something happens, in case there is like a extraordinary event again, you are now used to this payment and you won't sit in the position that, where you were put a year or so ago. Mm. On the other hand, people struggled to get to the home loan payments and they started building up other debt. Because, if your home loan is 10,000 Rand a month, suddenly, it was 8,000 and now you have to get to the 2,000. People tend to go and make loans in other ways, personal loans, study loans, all of that. So if you had to make ends meet by having more debt in the sense of a debt that is more expensive, in other words, if the rate is higher, then rather lower your home loan premium and pay off that expensive debt as fast as you can first.
Okay. You talk about, continuing to pay, your home loan at rates you were used to. But, when an interest rate falls, it automatically drops. Do you pay in more or pay in the previous amount? What's your advice on actually paying it? Because the banks will automatically lower that payment. If you were paying 7,000, you might pay 6,500 if the interest rate dropped. What tips do you have on actually continuing that? Because the actual debit order coming off will be the lower amount.
Yes, I'm glad you're asking me that because I don't always practice what I preach. And I mean exactly that. My bond is cheaper than it was previously and also my house is cheaper. So now suddenly you've got extra money in a month and it's very difficult to just pay it into the bond. There's always something that needs to be paid. So the best thing will be is to hire your debit order. Go to the bank and sign for a higher debit order, maybe for a fixed amount. So if you're used to 10,000 a month and it's now suddenly 9.5, make an arrangement with your bank that they keep on deducting the higher amount. Don't put it on yourself. We're all just human and we tend to never get to it. I don't know about you, but I would say, make next month, because I just need to buy this pair of sneakers first or, we all just humans. So as soon as you can get you back from holiday, sit with your bank and make an arrangement with the highest amount you can probably, pay.
Well, it's the right time of the year to do that. It's January for many South Africans. Mm-hmm. But, Corne, turning to first-time home buyers now, I know you're not necessarily a property market specialist, but for those wanting to get into the residential property market ladder, first-time home buyers, that is it a good time to jump in or should they wait for even lower rates? Or is that an unfair question?
No, it's not unfair because we must just make a difference here between a first-time buyer. Let's look at people that's young that just got married and the one their first home. There's never a wrong time to buy a house if you get the right property in the right place. Property is all about what you pay for it and where the location is. So if you don't own any property and you want to start owning your own property, even in high interest rates, there's never a wrong time. As I said to you on the previous occasion, that if you can get used to that high amount, it's actually golden. So no, if you find the right property and you can easily afford the payment with a little bit of an increase, maybe if something happens, buy your property. If you're buying to invest, that's something completely different. If you want to get into the market as a first-time owner for investment, in other words, you want to buy a property to rent it out, I would say be cautious. Make sure about the location, make sure about the fact that you're going to get your rental income, because at this stage, the premiums that you pay, your monthly repayment on your bond is still so much higher than rental income. And I would not jump into that at this stage.
Okay. Now, I know you gave some advice of rather paying off higher interest rate debt, like personal loans, credit cards, and that sort of thing. Let's turn the conversation a little bit to that now. For South Africans, should they be looking at just the home loans? Can you share some insights on what a difference paying higher debt would mean? Because sometimes, the credit card is treated like a cash card and people forget that it's higher interest rates. But, is there some tips on also car finance? It seems that the car market is starting to boom now with, the Rand performing well and lots of competition in the local market. But, yeah.
I would say let's start with the most expensive loans. If you look at a personal loan or a credit card, you're paying up to 22% interest on that. No investment can give you that return. Even if, it's that time of year where we have to contribute towards our retirement annuities. So you first have to go and just do that calculation. Don't just put that aside. Look at what you need for a tax deduction. Maybe your tax relief that you will get will be a little bit more by putting some of your money in an RA. But the expensive debt like personal loans, credit cards, your overdrafts, pay that as fast as you can and close them. Close that account. Secondly, you can look at paying off your car a little bit sooner. It depends on your tax situation. Every person is different there. If you may need a premium for your car allowance. And then we will look at your bond. But you need to make a calculation. I think just consider what you owe SARS at the moment, because it doesn't help that you pay off money on a loan, but then you owe SARS a lot of money because it's almost that time of year as well. Just look that your taxes up to date, because what SARS do is they just take the money from your account. So if you've put it into a loan, you've closed the loan, now you've got no access to money. What do you do now? So just make sure if you pay off debt that you still have access to money, on your bond, and maybe not close the loan if you've got some discipline, just to make sure that you, over this period where you do have to pay SARS and you do have to pay school fees, uni fees, accommodation, all of that you do have money available, even if it's expensive money.
Now, talking about lower interest rate environment, this question applies to both. If you have an existing home loan with a current bank and with interest rates coming down, banks are becoming more competitive, even other home loan providers. Can you shop around in the low interest rate environment as well for better, loans? And how is it to kind of transfer your loan to another service provider? Surely there could be penalties and that sort of thing.
Yes, it's not easy. You can shop around, and then sometimes some of the banks are willing to take over some of the fees, but that's only on big bonds. So what you're going to do first is you're going to have to go to your bank where existing loan is and give them at least 90 days, that's 3 months notice that you're going to cancel the bond. If you don't, they're going to ask you penalty fees, first of all, and that's quite a big amount. So now your current bank will appoint a lawyer to cancel that bond. So you're going to pay cancellation fees, bond cancellation fees. Your new bank will now appoint an attorney to register the new bond, which will be also for your cost, and that will be your bond registration fees. So the two fees you're definitely going to pay will be bond registration fees and cancellation fees. It may be that the new bank can waive the initiation fees for you to get you as a client. And you can also, if you're a good client, they may also pay the penalty for you to get you over as a client. Not going to happen a lot, but it is a possibility. So you have to look at what are you going to save? Do the calculation. If you save a lot over 10 years and you can write it off against the bond registration and cancellation fees, it may be an option. But Serene, I would really tell people to be cautious about this. Because first of all, you now need cash. You now need cash to pay the cancellation fees. You need cash to pay the bond fees. Where are you going to get that money? So unless you don't have cash to put your hands on and you've got a very good deal with a new bank, I would ask for advice first. See someone that can do proper calculations for you. Don't just hop banks. You may end up owning the bank money for bond fees. Paying that off, the new interest rate might not be worth it.
Thanks for that.
It is very expensive.
Before you go, we talked on an optimistic note compared to 2 years ago with interest rates, but there's a lot of positive at the moment despite what's happening globally. But, there seems to be a bit of optimism on the JSE, the Rand is stronger. Just from a personal perspective, you as Connie Velman, what's your expectations for the year? Could South Africa expect a better year all round, or are you a little bit cautious considering the geopolitics and that what could impact from that perspective?
I feel more positive in the sense that we're not scared, that something's going to happen, the market is going to crash. But I am also cautious. The markets are at an all-time high. Gold is at an all-time high. We are a little bit nervous. If you look at worldwide conditions, we've got no idea what Trump's going to do next and what the US is going to do next. So I'm not negative. I don't feel that you should move out of the market. We feel that we can have a good year. There's still good value in South African shares. But I think the time for stock picking is back. Not just investing in the JSE, not just investing in all share. Maybe just look at more specific stocks for now, since everything is high and expensive. Don't just run to commodities because they're very high at the moment. Maybe look at something else. So I don't feel negative. But if you look at bond rates, you know better than me what an amazing 2 years we had on bonds. And bond rates are going to come down. They already have. I mean, they're falling by the day. So going back to equities, not a bad idea as long as you see it as a long-term investment.
And the residential property market?
The residential property market is actually not a bad idea at the moment because, this is going to sound terrible to say, but, a lot of people got into financial trouble and had to sell their houses. But we always think it was then, people were in trouble then when it was COVID. People could keep their heads up for a year or 2 or 3. We are now seeing the domino effect. We are now seeing that domino effect where people struggled to keep up with their debt and people lost their jobs. Companies struggled to get back on their feet. And they had to let people go. And we see that coming through now, not a year or two back. So some people just have to put that properties in the market now, especially properties that they invested in for extra rental income. So there's definitely some good bargains in the property market at the moment. And I speak from personal experience. I just bought a house, and it is people that had to sell, go to smaller place because the business finally just couldn't carry all the debt. So don't think because things are positive in the market, it's positive for everyone. It may just be your good fortune that you find property now that someone else just can't afford anymore.
Kone, we'll have to leave it there. I appreciate your time on the podcast. That was Kone Velman of Portfolio.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories.